Good afternoon, and in keeping with our CEO series, which we've been doing for, I think, over 10 years now, I'm really happy to have with us Rael Diamond and Mario Barrafato, CEO, CFO of Choice REIT, which is Canada's largest REIT. And we're going to have a real engaging discussion about Choice and the real estate market generally. Choice REIT is a diversified REIT with a real anchor in the retail area, with Loblaws now representing over 50% of your income. But when you look at income as a whole, it's about 80% retail, 15% industrial, and about 5% in mixed-use residential. Those latter two areas are really growing, and we're going to touch on that and how Choice is really unlocking value there. Rael joined the predecessor to Choice, which was CREIT. Choice acquired REIT a number of years ago. Prior to becoming CEO in 2019, he was the COO. Mario is also from the predecessor entity, CREIT, and has been a leading finance executive and now a CFO with plenty of experience, one of the leading CFOs in the real estate industry. So with that as an intro, let's really dig into the questions here. We know the real estate sector generally, and public REITs in particular, have really been challenged over the past 12 months with rising rates, concerns about a recession, et cetera, et cetera. Having said that, the fundamentals in the areas that Choice is focused on, again, retail, industrial, and residential, have really been as good as I've seen them in a long time. Rael, for you, why is there this disconnect happening right now between where the market perceives it and the sentiment and really what you're seeing in your business?
Yeah. Look, so firstly, thank you for having us. So as you said, the fundamentals are stronger than ever in the three asset classes we operate, which are retail, industrial, and then purpose-built rental. I think the reason there's this disconnect at the moment is a lot of investors, particularly retail investors, read the paper every day and read pressure in office. House prices in Toronto slowing down, and they read mortgage rates are up, and therefore assume that translates to commercial real estate. And a large portion of our unit holders are retail investors, and therefore they may go and make an incorrect assumption and sell their units. But just from a fundamentals point of view, our grocery anchored retail have never been stronger. We just reported results last week. We got phenomenal rent spreads on releasing, rent spreads almost of 20%. Our industrial business, which is only 15% right now, but a meaningful avenue of growth in the future, truly has been on fire. We're getting, sometimes triple the amount of rent that we had from the previous tenant. And then our purpose-built rental, although small, has great long-term fundamentals behind it, and we believe will continue to perform well.
So, Rael, if I fast forwarded 5 or 10 years, how does that mix between retail, industrial, purpose-built rental, how is that going to evolve?
Yeah, we're really happy with the size and scale of it. So we don't expect it to change much. Our industrial, we believe that over the next 5 to 7 years, we can take it from 20 to 25% of our income. And then given how long the development cycle is on purpose-built rental, we, again, don't expect it to move meaningfully over the next 5 to 7 years. So fast forwarding, I would say, retail would stay the same size in aggregate, but as a percentage of our income will probably be closer to 70%, 25% industrial, and then 5%.
What about the balance sheet? We see higher debt costs, higher construction costs. How is that impacting what you guys want to do in terms of this growth plan?
We built our balance sheet to be a foundation and be sustainable, and as I tell Rael, it'll never get in the way of the business. So years ago, we set up a balance sheet with $1.5 billion of liquidity, staggered debt maturities, an investment-grade credit rating, a lot of unencumbered assets that give us flexibility. So we've been resilient, and so the only thing right now is interest costs. But again, having the lowest debt in the industry, it just doesn't impact us that much. Not having lines of credit with variable rate loans, we don't have a lot of that. That's where it really hurts you. So it eats a bit into our profits, but we've been very, very stable, and the lending environment is pretty strong for us.
So unlike some other real estate players who can't build that building or basically have pens down, that's not affecting Choice?
Yeah, I would say we have two advantages. So Mario touched on the balance sheet. So with our current balance sheet and current earnings in place, we believe we can invest, roughly call it $350 million a year in development without moving the key debt metric that we measure ourselves on, which is debt to EBITDA, which is around 7.5 times. So every year we can call it $350 million into development without impacting our leverage ratio. So that's the first reason. The second reason is by being in the three asset classes, we can invest in the different asset classes at any point in time. So retail, we've been intensifying our retail sites. For example, we're doing a series of Shoppers Drug Mart in front of grocery stores. That we believe will continue. Industrial, there are strong fundamentals, so that will continue. And then over time, we will shift more into purpose-built rental when the fundamentals are better. So we are unique that we can invest in any of these three asset classes and have the balance sheet to do it.
So based on how you're describing your growth and really contrasting that to the perception in the market, people think about Choice as a defensive, predictable, stable play. You're telling a story about how you're actually generating some growth. So you've got this really substantial industrial portfolio. You've got this growing residential. How are you going to unlock this value? How are you going to make people aware that there's real value and growth potential in that part of your business?
Yeah, look, I think Choice today is different to what Choice was, 5 or 7 years ago. That we are unique, that we have this stable income-producing business which is growing. And then we have real long-term growth potential from our developments. And I think more and more investors are understanding, the size and the power of what Choice is. And fast forwarding out, we will have, we already have the largest and will continue to have the largest and, highest quality retail portfolio. We will build, one of the largest industrial businesses. And then over time, we believe we can do the same thing on residential. It's just going to take many years. And real estate is really best suited to the long-term investor. And the long-term investors truly understand our competitive advantage.
Now I'm going to ask you to talk about the markets a little bit. We see great net asset value, stability, and growth. Clearly the market isn't appreciating that right now. I talked about a couple of reasons why. Do you think we might be close to the market starting to better appreciate what your company's doing?
I think as soon as the market sees stability in interest rates, and
we're close to that.
We believe we're close to that, and also the threat of a recession, visibility, what is happening with the economy. I think investors will come back more into equities, and we will continue to perform well. I don't know if you want to add to it, maybe.
Well, I think the necessity-based retail has really proven itself, very, very, very stable. And I think that we're now at a point where the industrial rents, you're seeing it in our numbers. You're seeing the development. It's zoned. It's ready to be constructed. So once people start seeing that it's actionable, I think sentiment will change.
So back to the retail for a second. You talked about how you got almost 20% growth in rents. When you think about this market, it sounds like the retail market's got a real lack of supply, so it's driving some real rental growth. Is this sustainable? You guys have been in this business a long time. Is this too good to last?
Over the last few years, as Mario said, our assets proved their stability, that there was continued traffic at our assets, our sites performed very well, and what we find is that today tenants want to be next to a grocery store. So for our portfolio, we believe it will continue, and as there's increased population, so we believe our centers will continue to perform well. And we are in a unique position, given our sister entity Loblaw, that we will invest in new retail sites, that will help Loblaw's growth. We do think necessity-based retail has differentiated itself from other types of retail, and we think there are definitely strong fundamentals behind it.
A recent investor day, you guys announced that over the next 3 to 5 years, you think you can deliver total returns to investors of about 8 to 10% per year. Help us understand how you're going to get there and what might be some challenges in achieving that goal.
We get to that, just our distribution right now is about 5%, and that's been very, very stable, resilient cash flows. We have growth, and we're able to reinvest that growth, and that'll get you about 2 to 3% growth. And then we have this development pipeline that, because of the depth of it, we can deliver about 1% additional growth every year. So that's really the composition of that number.
So if the development pipeline slows, Mario, so let's say you've got some unforeseen issues, so you're looking at potentially just 1% less than that. That's just that 1% of that total growth potential?
Yes. The key thing to our business is that 2 to 3% of NOI growth. And given our portfolio and given the way it's performed and given the quality improvements we've had, we see that being there for a long time.
On the industrial side, you guys talk a lot about the advantage you have in your land bank and how you've got a very low cost base. So now we know industrial utilizes a lot more land than, say, putting up a purpose-built rental. Are you replenishing some of that land? How are you kind of looking at making sure that pipeline continues to be fairly robust?
Yeah, so over the last few years is when we actually acquired this development land. So we have an existing portfolio of about 18 million feet of industrial land, all at Choice's share. Over the last few years, we acquired about 500 acres of land, which give us that potential. So we're under construction of 2 million feet. We still have 5 million feet more incremental to build out. And then we have many sites that we can actually redevelop. So right now, we're really focused on creating value in the existing land, which we believe we have a real competitive advantage from a cost point of view over others. And as we gain traction and as we utilize that land, so we'll look to potentially replenish it, but it's not right now on our radar screen.
So this is all this industrial development is all in Canada?
It's all in Canada. Choice is only focused in Canada. All the industrial development is Vancouver, a little bit in Alberta, and then primarily in the GTA.
I was just on a call with Blackstone the other day, and this is their North American portfolio, and they were effusive about their excitement on Canadian industrial. Why is this market as attractive as it is right now?
Look, I think unlike the US, which has limited supply constraints, Canada has real supply constraints. And if you compare, Toronto as an example, there's a green belt around Toronto, and there's continued population growth. And given those two factors, there's a real supply constraint and a real need for more generic industrial space. So we believe, industrial will continue to perform well. Market vacancies are less than 2%, and the fundamentals will continue to be strong for industrial.
Mario, you touched earlier on your dividend, and I think you guys just recently bumped the dividend, first time, I think, since 2017. What are your thoughts on that over time? Do you think that investors can expect more dividend increases going forward?
Yeah, just a bit of history. So in 2018, when we joined Choice, we knew we had some things we wanted to accomplish. So the growth in cash flows, reinvested it into fixing the balance sheet, improving asset quality, and building this development platform. And then last year, we're at a point where we decided to return some of that growth to our investors. And we think that going forward, given the improvements we made, we're going to have growth. And where we have growth, we'll share some with our investors.
And you think that is really on your pecking order of cash flow? Where would you put that?
This is pretty important to us. Our investors have been very loyal, and we think we have the inherent capital to fund the developments, and we'll have room. The growth will be shared with the investors.
As this business plan evolves over the next 5 or 10 years, so your industrial grows, your residential will grow, probably, as the industrial grows, is there any thought to potentially even locking more value by looking at maybe spinning off your industrial portfolio, because you've got such a big footprint? As big as any, GTA player, you've got almost just as much space on the industrial side.
Yeah, it's a question we often get from investors, and we know there's a lot of value creation through our existing development and capturing some of those market rents, given where our existing portfolio is relative to market. We think that over the next few years, we can capture that value within Choice. And if the market is not appreciating that value or not appropriately valuing our industrial portfolio, it gives us optionality to look at, an alternative structure like you suggested in the future. But right now, we have a real path to unlocking that value within Choice.
So better returns on developing that pipeline and then look at some type of future value.
Correct.
But today, though, the model is really valuable and offers investors something most REITs can't. That stability of cash flow from the necessity-based retail, the near-term growth in cash flow from industrial, the long-term growth with development supported by a balance sheet. It's a pretty attractive vehicle, and it works very well.
Yeah, definitely very unique. Last but certainly not least, in our investment process, we're focusing more and more on how companies are dealing with ESG, and as Canada's largest REIT, tell me some of the efforts you guys are making.
So our environmental pillar we call fighting climate change. We have a real focus to be a leader in fighting climate change. We're one of the first entities in Canada to get our net zero targets approved by the Science Based Targets Initiative, which is really the gold standard in trying to reduce greenhouse gas emissions. One of the first entities in Canada to publish a pathway to net zero report, which explains how we're going to achieve it. And then, we have this advantage of working with our major tenant, which is Loblaw, working really collaboratively with them to reduce their emissions, which are our scope 3 emissions. So, we're in a really good space and on a great path to achieving both our 2030 and then ultimately our 2050 targets.
That's excellent. Well, taking enough of your time, really appreciate both of you helping our clients, our advisor clients, our investor clients really better understand choice and why it is one of the leading REITs and certainly the largest REIT in Canada. And if you're interested in more information and CEO interviews, please visit our website or our YouTube channel.